world of economics, few metrics are as closely watched as the federal funds rate. It is the primary tool used by the central bank to manage the stability of the currency and the labor market. While daily headlines often focus on short-term movements, whether rates will rise or fall by 1/4 of a percentage point, it is often more instructive to view these numbers through a wider lens. Today, we are setting aside the daily volatility to conduct a structural review of U.S. interest rate cycles over the last 70 years. By examining the data from 1954 to the present day, we can identify clear patterns in how monetary policy reacts to economic conditions. This is not a prediction of the future, but a verified timeline of the past. Welcome to VeriScope News. Verified news, clear context. To understand the current economic environment, we must establish a baseline. Our data review begins in the mid-1950s. This period, following World War II and the Korean War, was characterized by what economists call the post-war boom. During this time, the Federal Reserve began to actively use interest rates to manage the business cycle, raising rates when the economy overheated to curb inflation and lowering them during recessions to stimulate borrowing. Between 1954 and the mid-1960s, interest rates were relatively low by modern historical standards, generally fluctuating between 1% and 4%. Inflation was also stable. This period established the standard correlation. A stable economy usually sees stable, moderate interest rates. However, this equilibrium began to shift in the late 1960s. Data from the 1970s shows a marked departure from the stability of the previous decade. This era, known as the Great Inflation, saw the Consumer Price Index rise significantly due to a combination of energy supply shocks and fiscal policies. To combat this, the Federal Reserve began raising rates aggressively. This cycle peaked in the early 1980s. In an effort to stabilize prices, the effective federal funds rate touched its historical high. In 1981, the annual average rate exceeded 16%, with monthly figures occasionally spiking near 20%. This is a crucial data point for context. When we discuss high interest rates in the modern era, they are often compared to the near-zero rates of the recent past. However, when viewed against the 1981 peak, current rates remain well below historical extremes. Following the stabilization of inflation in the early 1980s, the U.S. economy entered a period often referred to by economists as the Great Moderation. From 1982 to the early 2000s, the long-term trend line for interest rates was downward. While there were cyclical hikes, such as in 1994 and 2000, the structural highs of each cycle were lower than the one before it. The economy adapted to borrowing costs that settled in the 4% to 6% range for extended periods. This era also demonstrated the central bank's response mechanism to asset bubbles. Data shows that prior to the recessions of 2001 and 2008, rates were raised to cool down overheating markets, followed by rapid cuts when economic activity contracted. This brings us to the most significant structural shift in modern monetary history, the 2008 financial crisis. In response to a severe contraction in global liquidity, the Federal Reserve lowered the target rate to near zero, a range of 0 to 0.25%. This marked the beginning of the zero interest rate policy, or ZIRP. For 7 years, from late 2008 to late 2015, rates remained effectively at zero. This created a new environment for investors, businesses, and homebuyers. Capital was historically cheap, incentivizing borrowing and asset appreciation. While rates were briefly raised between 2016 and 2018, the global pandemic in 2020 forced a return to the zero-bound range. The contrast between the 1981 peak and the 2020 trough illustrates the wide range of possibilities within the U.S. monetary system. In one era, the priority was crushing double-digit inflation. In the other, the priority was stimulating a halted economy. This brings us to the current cycle beginning in 2022. Following the post-pandemic recovery and a resurgence in inflation, the Federal Reserve initiated a series of rate hikes. What stands out in the data for this recent cycle is not just the level of the rates, but the speed of the increase. The rate of change, how quickly the target moved from near zero to over 5%, was one of the fastest tightening cycles in the historical record. Why does this historical data matter? Interest rates act as the cost of money. When the cost of money changes, it impacts different sectors of the economy with varying lag times. First, housing and durable goods, sectors reliant on loans, tend to see immediate impacts. Second, corporate investment strategies often adjust, prioritizing cash flow over expansion. Third, the labor market may eventually reflect the cooling demand. Historical data also points to the phenomenon of yield curve inversion. This occurs when short-term interest rates are higher than long-term rates. In previous cycles, such as 1989, 2000, and 2006, this inversion has often preceded economic slowdowns. However, economic data is complex. While history rhymes, structural differences in the labor supply and global trade today mean that past patterns are not guaranteed to repeat exactly. To summarize our historical review, first, interest rates are cyclical. The era of near-zero rates was a specific policy response to specific crises, not necessarily a permanent state. Second, when viewed against the 1980s, current rates are moderate. When viewed against the 2010s, they are elevated. The pain or relief felt by the market depends entirely on which baseline is used for comparison. And third, the Federal Reserve's mandate remains constant, balancing employment and price stability. At VeriScope News, our goal is to provide the context missing from the breaking headlines. Understanding the 70-year history of interest rates helps clarify why the economy moves the way it does today. We will continue to monitor the data and provide updates as new reports are released. Thank you for watching.